Rex already kind of did a general introduction. Just going to introduce myself. I will be moderating the awesome panel we have here tonight. My name is Tyler Lingle. I'm a relatively new realtor with App Properties in the Indy Urban Advisors. Been in the game for about a year and a half. I've gotten the awesome privilege to be able to sell a lot of real estate in a short amount of time and get started in investing. But these guys are the experts for tonight. I'm going to be just kind of moderating and directing the discussion. Alrighty, so first question's just kind of a little bit about you. So background info about you, what got you famous? No, just kidding. But what got you to where you are now? What do you do? And then, of course, like favorite pizza topping, because that was the first question submitted to me. I'll start with you, Kenny.
All right, Kenny Hall, and owner and manager of Live Indy. It's a property management company. So I've been in and around real estate for about 5 years, and got into property management a few years ago, and have built a team and a good base of units managed. We're just over 300 units managed today, and we're growing, we're doing well, and love serving clients and tenants. Something interesting about me?
No. Pizza topping.
Pizza topping.
Pizza topping.
I got to go classic, just pepperoni. It's just simple, and just always look forward to it, though.
I'm Mark Buckingham. I have been in and around real estate probably for 5-7 years, something like that. And I'm with Full Circle Indy. So we're a social impact investment fund, really focused on how do we bring to market properties that are affordable to a median income buyer. So it's a very tight focus. Now we stray above and below that, but that's like the primary goal is in Center Township-ish, how do we focus on giving that opportunity, knowing that there just are not a lot of those opportunities. So it's a little bit different lane than a lot of the rental investment here, but from a rehab, new construction, and neighborhood-wise, we have a lot of experience in that realm. Pizza topping. Sorry, cut you off. Smoked eggplant. It's a good one. If I see it on the menu, I always go with.
Joel Matthews. I've been an active real estate agent for better part of 4 years. Got into investment real estate as a W-2 earner, and it scratched the itch, and I had to do it. I actually met Rex at this event, similar event, about that time ago, 4.5 years or so, kind of wild. Had just bought my first investment, got my license, joined the team, and between traditional real estate buy and sell and an investment niche, scaled personally, buy and hold rental units with my family. So I would kind of summarize and just say, building freedom and financial generational wealth with our family and clients, it would probably be a major driver with what I do. Favorite pizza topping, man, you can't, pepperoni. My wife would kill me if I brought anything else home, so pepperoni it is.
My name is Rex Fisher. I've been in investment real estate for almost 20 years now here in Indianapolis. We have been in realty since 2015, operating in a few different facets, sort of diversified into some other areas, property management, sewer scope, storage facilities, whatnot. I think what I love about what we get to do in investment real estate is there's always an opportunity to take something, to make it better, to evolve it, and to look at a critical mass that can empower other diversification into meaningful things. And some of the most exciting pieces of that are, before doing this, I actually ran the fundraising department at Shepherd Community on the Near East side of Indy, and today we have people who are working with us who were kids there when I was on staff, who are now buying their first home and leading other things here in the city, and getting to work with them side by side and see that kind of leadership out of these kids. I remember when they were 9 years old, right? 8 years, like that. It just doesn't get any better. It's a ton of fun. Favorite pizza topping? I have never seen a generously distributed series of ricotta globs screw up a slice of pizza. So I'm going to go with that.
Love it, love it. All right, next question. We'll start with Rex and then go this way this time. But what's your overall investing strategy and why?
That's a good question. It's changed. When I got started, it was really a cash flow play. I started buying $25,000, $30,000, $40,000 houses here in Fountain Square that would lease out for $600, $700 a month. Today, my strategy is much more focused on not where a property is today as far as what it can produce, but when it's going to experience a sea-level change in its ability to appreciate in value, grow in rent production in the next 2, 3 to 5 years. The city is on an appreciation rise and is pretty aggressively growing in that, even in today's market. What we're seeing is a more exacerbated emotional reaction. So the highs are high and the lows are lower, but the trend line and the rate of median appreciation in those developing areas is very aggressive relative to the rest of the U.S. The reality is we're just not making enough housing. And we've not been making enough housing in central Indiana for the last 11 years minimum. And we have more people coming here than we've ever had, which is both a tremendous problem and a phenomenal opportunity. But real estate is not going to be cheaper here moving forward than it is today. And so my strategy is to look at the annual cycle. So when nobody's buying, I want to be buying. That means I'm looking at a lot of stuff between Thanksgiving and New Year's. I actually came and broke into this place during the ice storm when nobody could leave their house for like a week. What was it, way back when? And, went through it and bought it. And I don't think I would have been able to get the deal if we hadn't had terrible, terrible weather and I hadn't risked frostbite. But that's where you get the opportunity to take advantage of, when you're willing to do what other people aren't to capitalize on value, in a market that shows a very consistent trend. All right. The lowest median price year over year we're ever going to see in the annual cycle on closings is January. This means nobody's buying anything in December. The highest by far, in a swing of about 20%, is June, July. So I use that strategy to go out and capture value and look at areas where money is going in such a way and buy groups that they don't fail. Right? Roger Penske buying the Brickyard doesn't fail. These 85-year-old billionaires don't buy the largest sports venue in the world for a good investment. That's a man who's spending on legacy. IU Health, $4.3 billion redevelopment of their downtown campus. Largest real estate development in healthcare. That's a big deal. You look at that along the 16th Street corridor, and in between those two entities, there's a ton of value. I'm paying attention to that, and that's where I'm investing considerably. And I could go on. This could be a long question, but I'll stop there.
I know it at our team meetings. Under 30 minutes of that.
For sure.
It's a good 30.
It's a good 30. Go for it.
Yeah, similar to Rex, I think the strategy's definitely changed. And it's kind of taken on two faces. So there's a personal me and my family, and there's a out-facing, my clients that I work with. When I bought my first investment, it was, can I live in this duplex and cut my standard of living? The motive to even get into that was I was living downtown Heron Morton, historical neighborhood. In 2015, when I moved back to Indy, and my landlord raised my rent by $300 a month, year over year, 2 years in a row, and I was paying I was the one paying on the 28th of the previous month, and tried to fight my case, and he claimed taxes were going up. I know they weren't going up that much, maybe they did. Now that I'm a landlord, I kind of understand. But it drove me outward to do what he had done. I was living in a townhome duplex and bought my first. And at that point, the question is just, can I lower my standard of living and have an asset that I can have short-term move out? As that morphed, and we added multifamilies and single families, and diversified out to short-term rentals as well. The scalability of that, when I buy a property, for example, I'm not looking at, I don't really even, not that I don't look at the individual numbers of the property, but I'm measuring it by the whole of my portfolio. And so that's more important to me than the individual production immediately in that property, as long as I, think it's in these developing areas or is building out. So I think the way I've looked at scaling and acquisition and the types of properties has definitely morphed. I think it's gotten really fun with my clients who've kind of followed suit and have done a similar portfolio scale. Specifically in the advising, and not that I know it all, but the collaboration of a team, of a community who's doing it together. You really learn from one another, and it gets really, really fun when you can start to speak in and mutually benefit, clients benefiting you benefiting them, and you're all helping each other get ahead. And I've specifically really focused on a local investment group. So I've worked with a few out-of-state guys, but I've really tried to harbor and focus on that local investor who lives, works, and plays here. And I've found the community, the tenant engagement that comes with that has been pretty beautiful. In just sharing dignity and equity while investing responsibly.
So again, it'll be a little different focus. So we're not investing long-term organizationally. We're saying we want places that we can either build on in the next 2 to 3 years, or 1 to 3 years, or rehab right away and sell. So we're looking at areas, but I'm also not buying a place in Heron Morton that I'm going to spend $400,000 to rehab to try to sell for $1 million, because that's also not our goal. Like, we're really trying to, so for us, it's how do we find that place that's going to have enough, we don't want the market to tank, so there needs to be enough appreciation, it needs to be an area that can support the rehab, which there's kind of a line. I mean, it's like a jagged line, but if you look in the city, there's sort of a line where, like, you go past this and it's not really, unfortunately, going to support the rehab currently from an appraised value. And even where we are, we're fighting appraisals some on really inexpensive housing. So it's kind of shocking that we're still fighting appraisals, but it's try to find that sweet spot on, can we get just enough value to give someone an opportunity, but then also see a return on investment.
For me, so I've got a small portfolio personally, but I'd like to focus a little more on Live Indy. It was overall my investment strategy with growing Live Indy is it was born out of frustration for property management. I think the bar is somewhat pretty low, and out to change that, not change the industry, but just be different and approach it with integrity, approach it with transparency. I think there's a lot of hidden costs with property management and areas that I think we can bring a lot of light to through just simple reporting and simple conversations. Pick up the phone, have that talk, keeping clients informed, keeping tenants abreast of maintenance requests, leading with integrity is just core. So one of the things I've been talking about is also it's built by investors for investors. So I get what clients are going through. If a maintenance request comes up and we have to pick up the phone and say, hey, you've got a water heater that needs replaced, that's going to be $1,200. you know how that actually impacts their day-to-day. That could be the mortgage that they're covering, and now they have to come out of pocket for that. That might change their month-to-month. That might change their family impact. Some of these people's goals are retiring from their W-2 and replacing that income to spend more time with their family. So if they're not getting that $1,200, that means some kind of stress level with their family at home or something. So we get that, we understand that, we walk into that with empathy, but also with a responsibility towards the house to make sure it's being a good long-term investment, and then also towards the tenant to make sure they have water, right? So just going about it that way and trying to do our best. It's not everything's going to go perfect, and we know that we're human, but just owning up to those opportunities and just having good conversations with the owners and tenants in a way with integrity. So I think that's the area we invest the most at this point.
Yeah. And I love that about your property management company, but I'm not going to let you take that cop out because I know you started investing through your primary residence, like Joel. So tell me about, because a lot of people in this room don't have any investments, right?
Sure.
So
yeah, I can touch on that quick. Yeah. My first property was up in Home Place in Carmel neighborhood, and bought it early before it was annexed by Carmel. So I feel like I got a nice discount there. Bought it for, it's a 3-bed, 1-bath, bought it for $152,000, already rehabbed. So I feel like I got in at a sweet spot. Mortgage was just under $800, and that was pretty sweet because we were paying $900 in rent. And I was like, okay, now we're saving money and we own this home. This is really cool. And started to get that knack for real estate that way. 2 years later, we bought a house in Broad Ripple, rented that out to a tenant, paying $1,600. So cash flow on that to myself, managing it, I was like, this is just insane. I was like, wow, I can see why people scale quick if they have an opportunity to pay the mortgage and then cash flow. And if you're good, you can save it and then buy the next property. The down payment starts to snowball. So fortunate enough to meet, my best friend in college became a private funder, and we go 50-50 on the work. And so he's all the cash, I'm all the work, and we've scaled, we've done 2 burrs successfully. So we bought them, rehabbed them, then we rented them out, and we refinanced, got all of our capital initial expense and got all of our rehab expense out, and then went to the next one, did it again successfully. It's a little harder now to do that. It's a pretty trendy topic, but with interest rates going up, I think it's a little more difficult, and so now we're looking for just a good, strong appreciation game, similar to what we're talking about now, and I think it's just a good opportunity to buy in Indy if it cash flows or at least breaks even right now. We'll see that come back around, and big believer in that in Indy's overall direction. So.
All right, so that was some really good background information. Now, some pointed questions, and these were submitted by you guys. I had a question asking for questions, and so these are kind of the top picked questions. This is specifically for Rex and Joel, but you guys can chime in if you'd like to. But what loans or financing options have you used or found most successful when purchasing a new property?
You want to go first? It's another thing that's changed, right? So standard residential loans are getting pretty salty. You guys may have noticed, right? You're taking a point. So some of these are coming in high 7s, low 8%, and with your loan origination fees and whatnot, that can be pretty challenging. So I have really appreciated moving with hard money fast. It's especially if I have a property that I can get to a market rate quickly. Hard money is all about speed and using that speed to reduce your total cost of acquisition and rolling that into another vehicle. One thing that I think is really being overlooked is the ability to use hard money in 6 to 12 month bursts across, let's say, 4 to 8 properties, and rolling those into a larger commercial loan. Commercial rates right now that I'm getting on 4 to 8 property packages is coming in about 5.6% interest, 25-year AM, going up to 80% LTV, and I can almost always negotiate interest-only payments for 12 to 18 months while I get those up to, if I need more time to get those up to market rate. You have a lot of local credit unions that need to activate their capital with fewer people doing it right now because there's still supply chain issues. There's still things that are bottling up their ability to deploy their capital and make money. So I don't know too many times I've seen commercial loan rates be this far below standard residential loan rates. And it's pretty solid. You can actually get a 10-year rate lock on many of those as well.
Just a follow-up question for you, Rex. Do you use your own money when financing rentals?
No.
Talk about that.
Yeah, so I think everybody that I know who got into trouble in real estate had the same problem. And it wasn't that the deal didn't work. They ran out of money. It's every time. So I keep my own powder dry so that I can, one, be lendable. I have to keep a minimum $400,000 cash on hand just to keep the banks happy when they look at the balance sheet. And that's across the, when you have that portfolio and that kind of liability and guarantee, you have to have some amount of cash in the sidelines. But also, you have a run where you're going to have sewer laterals that collapse. You're going to have roofs that need to be replaced. And they come at there are times where it's 6 major 5-figure cost items hit, and you got to be ready for that. Having the margin, the financial margin there, the liquidity to be able to move on that quickly keeps my emotional capacity free to be able to focus on the right things as opposed to freak out about where in the world I'm going to find the cash to solve this problem and get this. And they stack, right? It isn't just that a lateral collapsed. It's that a tenant is understandably freaked out about what's in their basement and has to be displaced to a hotel. And I mean, you don't need too many of those to, I sit across the table from a lot of people who are going, I don't want to do this anymore. And I understand the way they've done it and they're experiencing it is not fun. That's not an enjoyable way to do this work. So I keep as much of my powder dry as humanly possible. And what I've found is that if you invest correctly with that hard money up front and you do the math, that you can move very quickly into deals with hard money, get that turned around up to a market rate that allows you to cash all that out. And honestly, there's a number of times where you can even pull additional cash out because you're going to find the properties that are so under rented, right? I just sat yesterday with a guy who's got 35 units or 35 properties. And he's like, man, I'm just, the rents aren't keeping up. And I went through and I'm like, dude, you are like 60% of market right now. He's like, yeah, I just haven't, like how many of your leases are current? Right? He's like, well, they're pretty much all month to month. And I'm like, that just means you haven't followed up with anybody about, they can just say, I'm out. And I mean, we are third in the U.S. across the top 50 markets size-wise in year-over-year rent appreciation at 15%. Salt Lake City, Utah, and Raleigh are the ones that are beating us out. But again, and we are sub 4% vacancy. That is not a problem that's going to fix itself overnight. We have to build our way out of it.
Which again goes back to the, I get probably Joel and everyone here gets investors wanting to cash flow Indy. Oh, Indy is the discounted cash flow market. Mm-hmm. It's because we were down here for so long and people don't see that the curve has now shifted to here. Right. So anyways, the whole Indianapolis as an appreciation play. Joel, I'll let you talk.
Yeah, I'll kind of piggyback off of the kind of portfolio acquisition he was talking about of acquiring multiple and at the same time and refinancing them. But generally, I've kind of looked at it as really, 3 different directions you can go with lending, and this is just me personally. There's a lot more ways to cut it. Your short-term hard money that you need a clear exit strategy for. If you know somebody and you have private equity or funds you can tap and pay back, that's probably the freest, easiest money you can tap. Personally, that connection was pretty challenging for me and where I come from, and I recognize not everybody has, that privilege to tap that. But that networking there could be a good use of time in order to do so as rates continue to go up. Traditional lending is more challenging. I would say it can still be done, and I do think a lot of these traditional lenders right now have gotten creative with some of the rate hike and then buyer hesitation we've seen last 3-4 months or so, by rolling out more investor-friendly products like variable ARM rates, 7, 10, 15-year ARMs. Citizens Bank would be one for some wanting to get started, particularly owner-occupants. I think their 7-year, for example, was a 5.3%. Their 15-year was up to like a 5.8, and then anywhere in between, depending on the term. You can make, I could make a variable ARM work to wait out the high interest rate, to make a short-term rental work, or that should cash flow a little more than a long-term rental. I could make that work with some, duplexes and things if I can. It's really about capturing that creative loan rate. Going to kind of what Rex was saying, and then I would say, your kind of commercial acquisition, something I'm kind of teeing up and doing personally, is I kind of have two options now with commercial lenders. I can buy with hard money for short-term periods, high interest debt. Most of these are properties you improve to different degrees. Buying 3 to 4 of those at a time, or more, you really can work that to use a very little amount of your money. So if you've done one, or if you've done a flip, or you've bought like an investment property with 20-25% down, in theory, you can do a hard money loan across 4 properties using about the same cash down of your cash. Obviously, you want to have the right contractors set up that you can trust, that can get things done. My guy James in the back will do it himself when the contractor fails. I'll put you in touch. But generally, the way I've looked at that is if I can create value by using somebody else's money, even if I'm paying pretty dang high interest, it's a no more than 9-month run, and at the back end of it, I'm using minimal to little of my money when all the dust settles. It's really the in-between that I think is the most challenging for most who operate in more of a monthly, kind of like we talked about today, like a monthly income versus wealth and net worth creation mindset. So when you look at like your income on what bills do I have due every 30 days, and and you look at this more from like a paycheck to paycheck mindset, it's really hard to get over the interest rate of hard money loans. But if you can look at this and zoom out and say, we're gonna borrow $500,000 to buy 4 properties at the same time, multis or combination of multis and single families. We're going to set up a relationship with a commercial lender to refinance these in a package, either cash out, or I'd be happy to break even today. You're using someone else's money to build a $800 to $1 million portfolio pretty easily that's leased, cash flowing, improved, and renovated. And all it is somebody come alongside and navigating through those vendor connections. And they're out there and they're ready to loan. I could say a lot more, but
I think something to keep in mind with hard money, and Rex, you've taught me this, and I know, Joel, you do this. Hard money, especially if you're using private money's friends, families, acquaintances, IRA money, I know you use a lot. It's how can I provide value to you? I'm giving you a solution right now, especially with where stocks and equities are right now. Mm-hmm. Do you want to make 10% passively on your money?
Yeah.
Who wouldn't right now? All of us in this room could be asking people that.
The best question I ever asked when I first got into personal money I just called up friends and family. It's like, give me an interest rate that would make you ecstatic to loan me $100,000, right? And like some people would go like, 7%. It's like, done, right? What'd they say the next time? Hey, you gave Bob 10. I was like, yeah, and I would give him 10. But but when I came and paid them back, they didn't go, okay, thanks, see you later. They were like, let it ride and meet my friends, right? And that relational development that really peaked in 08, 09, because everybody was pulling their money out of the stock market, right? And they didn't have any, and nobody could get a loan, right? So I had all of a sudden this access to capital, and I could just go pick up short sales and foreclosures, and I had no competition to do it. So yeah, and some of those people, a lot of those people are still with me today.
And I was just going to say one thing. The big power of the bundling process, so if you heard the term BRRRR, buy, rehab, refinance, repeat, it's traditionally done in the way you might see it on a Bigger Pockets or some Facebook group or something. It's typically a single family. You're buying, you're renovating, you're similar almost to how you're building new construction. You're selling rather than refinancing, but you're looking for that tail end value on one property. You're paying a set of closing costs to acquire it and to refi it, so you're really paying two sets. On the bundling process, it's the same concept, just your closing costs spread across 4 properties. So in some sense, you're saving quite a bit and simplifying it by doing it one time rather than doing a single property at the same, at a time, paying 2 sets of closing costs on each side. You're paying 2 sets period across your 4. I think that's some of the power of the upfront savings, and you're doing it in a 6 to 9 month period as opposed to one every 6 to 9 month.
Yep. This next question is a question for Kenny and Rex, but you guys can chime in too if you'd like. Looking at the future, this year, the past 6 months in the market has been very mysterious. I don't even know the word to describe it. What do you see coming in central Indiana? So we're not talking nationally on the coast, which is where most of the news comes from. In central Indiana, what do you see coming, and what are you doing to prepare? Kenny, go.
Please, by all means.
Okay. I like where Indy is headed. There's a lot of development still happening. IU Health Hospital's coming, and a lot of big commercial projects still happening. I love to see that, even with what's been happening with ramifications of COVID and just the market and the economy. And I like to see neighborhoods still being worked on. I like to see the flips happening. I think what's going to happen right now is somewhat of a plateau right now. Rents we're seeing are falling a little bit behind. Some investors are excited about remaining the same with their lease. If they're locked in at $1,500, they're okay renewing or raising $25 instead of a standard 3% or trying to drive market rent. So I like to see just a renewal this year, but I don't expect them to be the drastic increases that we've seen. We're actually speaking to 15 to 30% in some neighborhoods. Over the last couple of years, it's been wild to see those rent increases, and it's hard on tenants. But I think we're going to see a year of somewhat plateau. But I think this is the time for investors to be getting in and buy it up, because it's going to keep going in the same direction. A lot of commercial opportunities, driving a lot of new jobs, a lot of people moving in here. The cost of living is still great. So I think that's kind of where I see it.
Yeah, I'm really encouraged when I look at central Indiana. Out of Illinois, Michigan, Ohio, Kentucky, Indiana, there is no greater land area with more people moving to it than central Indiana. We're seeing a tremendous migration out of Illinois, specifically Chicago, but in general, Illinois. We're seeing a ton of people from DC. We're seeing a ton of people coming from the West Coast. I think the brass tacks reality there is we have a better city than we have ever had. I mean, by significant margin. 20 years ago, I used to sit on an advisory board that would talk about how do we get top talent to come to Indiana, right? How do we get them to Indianapolis? And the answer nobody liked, because it wasn't a fun, quick answer. You make a better place to live. But we've done that, and there's more being done about that across the next 4 years than we've seen in the past 30. Okay, there's more changes to the skyline of downtown Indianapolis happening by the end of 2027 than we've seen since all the way back to 1990. There is a ton going on here, and when you have 9% year-over-year inflation in places like San Francisco and Boston and New York City and LA and Seattle, where your cost of basic necessities is such a significant portion of your monthly income, things really start to hurt. And we are now a city that is in a region that is good enough to be a fit for someone who's living in those other urban environments. And we're seeing the crossover. We have a great airport. We have great transit. We don't know what traffic is. This is a great place to live. I do think because of the scarcity of housing, I think we're going to continue to see considerable rent appreciation, value appreciation. We just have more people who are moving here who are used to paying a lot more for housing, a lot more for everything. I still get people who come. We do some work with executive recruiting at the IU School of Medicine. Okay, we won last year the leadership group from radiological oncology from Cedars-Sinai. If you're getting doctors from Hollywood to move to Indianapolis, something has changed, right? We sit down with them and they say, yeah, I don't want to really spend more than about $2.5–3 million on a downtown condo. I'm like, well, you're in luck, right? And they laugh when we start going through what they can get for like $800,000. They laugh, like tears in their eyes laugh. There is a group coming here we just have never seen. And we need to be ready for that. And the scary part is that means we have to reach a little bit more than we have in past days. But I'll tell you, the guys that are coming in, the people and investors that are coming from other states who have been playing this game in the tier 1 cities for the last 12 years, they're eating it up. And they've seen it, and they've done very, very well playing that game. And it will taper off, but it's not going to be for a while. We have a long way to go. We are not without our problems. We have issues in affordable housing like you wouldn't believe. We are still, relative to the other U.S. urban markets, far too affordable for our economic strength. Again, relative to the other U.S. markets. And right now, that is benefiting us like crazy. $22 billion being spent by the state next year on economic development. That's in a very economically healthy state. That's a big deal that's bringing a lot here.
Yeah. Question for really anyone, but specifically Mark. I want to hear from you since you haven't talked in a little bit. What neighborhoods, so thinking Indianapolis, what neighborhoods do you focus on and why?
So we're focusing mostly Center Township, so it kind of stretches a little bit on the east and west. For our purposes, we don't go much above 38, and I just don't know the south side as well, so we don't come down the south side as much. We have a few things in Fountain Square, and then if you kind of like work your way up through the east side, kind of both sides are rural, a little bit past Sherman, not much, and then, you know, kind of through the edge of Martindale, Brightwood, and then you're kind of sort of then going across just south of 38th and then down Riverside, Hawville. So that's at a high level. The reason for that area is kind of something I talked about before a little bit, is that that's an area where there's enough going on, there's enough momentum, be it IU Health, be it something the city's investing in on 10th Street or whatever. There's enough momentum in an area that we're not going it alone because we're not going to get to the point where we can rehab a house or build a new house and sell it if there's not some other momentum. But we can hopefully come alongside that and help spur that momentum along. So if you're looking at those areas, there's momentum. I mean, there's something going on kind of in all of those areas as you circle around. And then there's micro pockets within that are probably better. Some are better than others. I would say from a rental perspective, I would probably look just one little step further past that because we've already bought up. I mean, like people that are rehabbing stuff have already bought up a lot of the property. So the stuff that we own that's either in line to be rehabbed or lots that we own has appreciated tremendously because everybody knows that's coming. So if you're trying to get ahead of that, you want to maybe go just a tiny bit further, or sort of like closer to Washington, closer to Michigan, just some of those areas that are right on the edge, but that in 5 years will be in that place.
Anyone else? Location, where you focus on and why?
I mean, I think the west side, if you draw a triangle between the Brickyard, where Elanco's headquarters is going to be, up to 16 Tech IU Health and back over, guys, the land will be worth more than you can acquire the total property for today. You can't bring that much money into that area and not see an absolute sea change. This is not a popular opinion, but I think actually townhomes and condos in downtown have been some of the only real estate that stayed fairly depressed over the last few years and can't keep it from popping up. I mean, billions of dollars are being dumped into the mile square. It has to push it over the edge. So I think there's going to be a significant appreciation play there.
Yeah, I like that thought of thinking of properties that can't possibly go down, and $70,000 livable houses on the west side. Mm-hmm. They can't possibly go down.
They don't have that far to go.
Yeah, right.
When the first duplex I bought was in Mapleton Fall Creek, and I bought north of Fall Creek. I mentioned I was living in Heron Morton, and I went from I think I can afford Heron Morton to a year from that. I was like, definitely can't afford Heron Morton, to maybe I can afford Fall Creek Place, just north of that, south of Fall Creek, the Parkway. And I was like, by the time I actually got around to buying, I was like, nope, can't afford that either, unless I want to do a lot of work. And so I moved into Mapleton Fall Creek as my first duplex buy. John's here, Kennedy, somewhere around here, lives in Meridian Kessler and bought a lot of his initial properties in Meridian Kessler. And it's really interesting because when we first, this was 3-4 years ago, it was around that where we met, he wasn't really wanting to buy in Mapleton Fall Creek. And now, he bought his first property in Brookside. And so to speak to kind of what you were saying with, I think, some of that triangle or the outline you kind of drew where you're building some of the median homes, within that and on the fringe of that seems to do really well, especially if you're getting started, or if the return you want needs to happen quick for whatever your life circumstances are. I think that's the lowest hanging fruit in or around those low to moderate areas. I think if you're young or if you got a little bit of a portfolio and you're looking to add more, there's some ways to look at more diversification within that. But I think that's, low to mod census tract would be
Yeah, and I know I'm not a panel member, but I've told Rex this, I've told many people this, certain areas of town with parks and waterways that are not looked upon super well right now, such as Riverside, Fall Creek, Brookside, there's a few others. In 20 years, you'll see those mansions will be back to life, Mm-hmm. So
pay attention to Lebanon too, by the way. Lebanon, Indiana, all of Lebanon, Indiana is under construction like you wouldn't believe. And there's a ton of money being dumped in there as well.
Yep. Kind of finishing up, question for anyone. If you had to restart right now
there's people in the room that don't have any investments yet. They've never done anything. What would you do?
I'd buy 10 years previous.
I think you need to construct your narrative. You need to know why you're doing, what your purpose is, and what you hope for. And if you can put that together and communicate to other people, they can catch that fire. And if you do that, you're going to be okay. But so many people want to get into it and they don't know their story. And if they don't know their story, no one else can get handles on it. They don't know how to approach us.
Anyone else?
I would house hack. I did a great move in and it rented well and cash flowed, but I'd try and live for free. Whether that's roommates, just get in a room in a single family, or get the duplex and rent out the other side.
Going back to the low to mod, as you think about maybe a first investment property you live in, whether that's a duplex or a single family, there are a plethora of low to moderate loan products that would allow you to put 0 to 5% down on a single family to a duplex property. To me, that's a no-brainer. If you have the stomach and ability to do it. I think there's a lot of creative ways outside of that without living in it, but probably would require a little more capital. Even, I think, the hard money route, you want to have that capital at least in your, kind of what you want to keep that powder dry or have it in a savings account as a buffer, as an emergency, even if you're using other people's money. But I think there's a lot of ways to tackle that.
Yeah, just a short plug, but if people are wondering about those low to mod loans that are, 5,000 or less down, Joel or I would, or Kenny or anyone would love to share those. But
Which those would apply for a lot of your builds as well.
yeah.
No, I think all of our buyers.
Yeah. Now's the time for questions from the audience. So if you have a question for anyone or everyone.
Just heard talks or rumblings that multifamily space is getting a little crunched in terms of seems like builders are building a lot in that space. Do you see anything happening there in terms of lower rents as complete more units?
I'm not seeing it right now. I do think there is a premium demand on single family right now. I think those are the ones that they're leasing real fast. People are willing to pay a lot more. I think we have to pay attention to the cyclical nature of rent rates. And on renewal, look to adjusting to the peak market. So if you have a rental that's coming up for renewal in November, offer a 6 or 18 month renewal. I think making sure that you're hitting peak market is a big way to reduce your vacancy and make sure that you're producing what you can out of it. I actually think you're seeing the single family homes appreciate and rent even more, which is making the multi-units look a little less, but they're not slowing down. They're just not accelerating quite as much.
I do think I've felt this, to kind of elaborate or piggyback off the seasonal, like November through January, I'm sure you can say like typically harder to get stuff leased, less people looking. I've had more days on market on a few of my multifamily rentals than I've ever had. I think some of that's a little bit locational. I think some of that's definitely seasonal. I've not had a lot I haven't had many tenant turnovers during that window, and I've particularly avoided it or tried to sign 18-month leases, especially if I'm locking one in at that time so that it expires in the spring. So I do think that's a part of it. I don't know that I would say I can see any data yet that would suggest rents are going down. I think they always go down. November, December, you got to get creative if you want to limit your days on market a little bit within Center Township. At least, I think that's been my clientele and network's experience.
In terms of rents, and Well, rents are a little bit slower right now. We had quite a slow in the December to the new year, but January picks up. I'm always surprised by January. It's like a new, fresh wave of people coming through, and we're done the same thing. It's like the summer lease cycle. People get a little freaked out with a 6-month lease because they think they have to move. So we're always like, well, you have the first right to renew, or let's go longer and try and get them to the next summer. So yeah, and sometimes we'll sign 2 leases at the same time. So we'll set up a 6-month lease, and then we'll sign another 12-month lease to start at a new rate. So they're already locked in, peace of mind. It's like, hey, owner, here's 2 leases. You're ready to go.
Have you seen 2 bedrooms be slower? Like some
Yeah.
of my 2 bedrooms that
Yeah.
seem like they're really saturated in the market compared to my 3 bedrooms rent
Yeah,
right away.
the 3-bedroom, and if you can get another toilet, just 1.5 bath is huge, huge. It's like,
Yeah.
just keeps the family happy. So, yeah. And if you're doing like a 1-1, it's 1 bedroom, 1 bath. Those are really tough and have high turnover. So you're gonna just see the turnover costs go up, because if anything changes in their family situation, that's the first place to move, because they got to have more space, whether that be working from home, have a kid, just some kind of lifestyle change. So.
With sort of the rise in the midterm rental strategy, especially with the hospital systems that we have here, particularly downtown, but also essentially St. V up north, is there a particular radius you guys would look to target in terms of where those traveling professionals might stay, and the sort of type of place you're looking at, 2-bed, 3-bed, that sort of thing? Do you guys do any of that or have experience with any of that stuff?
I can share. I think Joel might do this. I don't know. I have a midterm rental. Well, it was a short-term rental Airbnb. It's in Christian Park, which you wouldn't think of an area that maybe would be where a travel nurse would necessarily want to stay. No offense if you live there. It's a great neighborhood. But I do know what typically they're looking for, because I've asked many nurses who are travel nurses. And, you want to be within 30 minutes, 25 minutes. Methodist is where most of them go. IU Health, they're not really as much on the north side. There's way more going to IU Health. You want a garage if possible, and if possible, 2 bedrooms, lease up really well with them. 4 is probably too many at that point. You're going to want to maybe convert it to rent by the room to cash flow, which is an underused strategy, I think, in general. But that's what I'm seeing, at least. And the rent rates usually between $1,500 and $2,500 for a 2-bed, 3-bed house.
I do think those stipends are gradually decreasing.
Yeah.
Right now, we're seeing those come down every month. So there might be a little bit of a squeeze there at some point. But to Tyler's point, I think most of these nurses, or many of them, are coming from areas where a 25-minute commute may only be a few miles. But in Indiana, we can just about get across the state. I think we have a much greater radius, and it's a lot more about what the property offers. I do think a garage is very important, and that it looks like a place they want to be.
Yeah, the extent of my experience with that, I don't specifically target the midterm or the travel nurse or hospital professional or whatever, corporate traveler partner. Some of my Airbnbs that traditionally, maybe historically, 5 to 8 years ago, St. Clair Place, just east of rural, kind of just west of Arsenal Tech there, Woodruff Place, like that, east of Woodruff Place. Springdale, same kind of little pocket north of 10th Street. I don't know that I would have expected that 5 to 8 years ago, but I think in the last 2 to 3 years, some of my higher end properties that I've done marketed as long-term rentals or Airbnbs have had pretty good luck capturing those just automatically with like a travel nurse who books for a month, renews month to month, or books for 2 and extends, or hops. I think that's where I've personally had my experience. And I don't know that it's had to be like it was maybe 5 to 8 years ago, like if we had that market for that. It would have been like Mile Square, right? Or like condo living almost. And I think it's encouraging to see like it's branched out. It just shows like what's happening farther out.
HELOCs are great. Cheap underwriting. I think it's really important to communicate to the loan officer what you want out of that, because an appraiser is going to go in there and they have no reason to stretch. So you need that loan officer going in and really teeing it up to hit the value that you need. And I think that's a step that gets missed a lot. And then you get a drive-by appraisal that gets, half of what you were planning on. And once that's out there, appealing that, getting an appraiser to go, yeah, I was wrong, is real tough. But the floating interest, I love interest-only payments. I love that you only pay for what you're borrowing. That's great flexibility. I really like that strategy.
Yeah, the only thing I'd say that is kind of speak to the leverage on that. I don't know if that was my only source of like investment capital. If I would like go out and try to buy 4 properties and do that commercial process, I would really want to just know that's buttoned up. So if there was a really clear plan and I had, an agent, property management, all those contractor pieces in place, and I felt really good about it, I might consider leveraging that and doing that, because I think you can get all, if not, minimally most of that back out on the back end if done well, if you have the right people kind of walking with you. I would definitely not pursue that kind of leverage if you don't have those pieces. You could, in a less risk-based, pursuit, if you're looking to do your first or add one more, maybe in something like that. We were talking about it today, using that and maybe doing one with that, traditional down, some money in reserve for renovations, and just really have somebody like harbor in on that, the right fit. That's maybe not a full gut reno, just depending on what kind of equity you got. But maybe something that just, needs the right cosmetic stuff and the bones are solid. That'd be, a no-brainer, and you could knock out a couple of those pretty quick.
I think there's also an element of if there's the right deal, you'll find the money, and not to say that there isn't, privilege and people with better networks, but I would challenge the assumption that there's not hard money available to someone. If you bring a deal to someone that has a pretty big network and say, hey, I'm just looking for financing options, I think you'd be surprised if the deal's right.
I would piggyback off that and say someone once told me when I was younger that the money is the easiest part. And I just laughed at that point because I was like, what? That doesn't make any sense to me. These multi-million-dollar deals or hundreds of thousands of dollars put into these things. And it's just like, yeah, if you bring the right opportunity to someone, and it's just like Rex said, they might say, yeah, 7% is good for me. It's like, let's do it. Sweet. So.
They always go up.
Yeah.
If I had the option of doing an investment build out on using a HELOC on my personal residence or going to hard money, every single day I'd use my HELOC for that. You're going to have lower interest, lower debt, and you're going to have 10 years to pay that back versus 6 to 9 months if you run into something.
Well, you first.
So I guess we talked about appraisals kind of briefly and quickly, but I saw over the last couple of years fighting for single-family home appraisals really I kind of got over that. I didn't have to fight as hard anymore as sales kept happening. But getting into multifamily now, talking quads and up, it seems like all of those are sold off market. So finding ways to be able to convince an appraiser or the lender, like, hey, this is what I think it's worth, this is what I believe it's worth, this is why. I guess I just want perspective on, I know rent obviously is a driving factor of those, but how do I argue, okay, the county's telling me my property's worth $600,000 because that's how much they want to tax me at, but then, an appraiser's coming in because there's only 2 sales in the last 5 years because all these quads are greater than that are kind of being sold off market.
I think your hard money lenders are much more flexible because they're not exposed to the federal regulation. I also think, and we don't talk enough about this, but on a commercial loan, you can opt to have a commercial appraisal. Now, it's going to cost you 3 times as much, but you can tell that appraiser what you need to get out of that property and why you have a case for it and put it in front of them. And you can adamantly jockey for that. You can even select the appraiser with some lenders. to go in and champion your value because they don't have the federal regulations either. On those deals, that's where I've had the most luck is really engaging the lenders who don't have the federal regulation in their hands tied around realities that aren't positioning me for success.
Yeah, and I'll speak to that too real quick. I don't really do this with commercial outside of bundling residential properties, so I'm not, 1 to 4 units, not 5+, but I've recently, and kind of through just the lending relationships, been able to use a hard money appraisal that I order. I hate to say that it's mildly influenced. It has to have like support for it, but it's definitely influenced. But because it's not being done through Freddie, Franny, your traditional lending, you just need a rational argument for it and like some data there to support it. It's not going to have the same restrictions, to Rex's point. And I've had my commercial lenders use that appraisal for the back end. So I'm not having to get, now, not always, not every lender, but if there's that relationship there and they're a commercial lender that's kind of built and willing to do that, you can know that up front, use the appraisal, one appraisal on the front end, hard money to acquire, and have that backed in using the same appraisal once work's done and it's, leased up and the appraiser certifies it as complete.
I want to make sure there's time for, questions and mingling after this. So we'll do 2 more questions, then
Great.
wrap it up. Jake. Yep.
First, thank you for answering a lot of questions. I'm actually on the data point that you mentioned that came from New York 6 months ago.
Mm-hmm. Welcome.
Thank you.
There we go. It works.
So I understand that India is a landlord-friendly state, but recently in the media it's been portraying that all these bills coming up to protect the tenants' right and all that. I'm kind of curious to see where you guys are thinking in terms of the direction of how things are changing. Is that like a good way or a bad way, or where do we see like the future? Where do you guys see that going?
Well, here, I'll jump in from probably a different perspective. I like the potential of changes because I would think every person here that owns property is a landlord that it's like, oh, that's great. I already do all of that stuff. So you gotta, it's like a matter of perspective. Like I think that they're coming from way over here where I've bought places that, I bought a place I had to tear down and there was a tenant in there and I'm like, dude, I can't let you stay here. And then we had to tear it down once we got in there, so we lost money on that deal. But still, it was that bad, and that somebody was living there, and that's not an uncommon occurrence. So personally, I wouldn't worry about that at all if you're interested in the level of property management that this group would provide.
Yeah, I would echo the same thing because it's more about treat everybody fairly, and if you're going to have a similar screening process for a tenant, or you're going to have a way of dealing with maintenance requests in a timely manner, all these things that are coming down the pipeline are more in line with making sure that actually happens and following up on it. But I think you said it perfectly. We're already doing a lot of those things. So
My client James in the back, we were under contract on a slumlord in every way, slumlord property. I really want to say his name, but we kind of discovered that pretty quick after being under contract, and we're having conversations with the tenant. James comes back the next day. We didn't end up pursuing the contract, so there was a mutual lease due to condition. But James went back.
I did have to sue him.
Oh, you did?
Remember?
Yeah, that's right. There was, pretty wild, huh? But James went back the next week after we did mutual lease, slapped a tenant rights notification on the tenant's door and gave him his tenant rights. He didn't know them. And I think that's, what we would say like investing responsibly might look like. I mean, I love that story because it's local investor looking for the equity and the dignity of people, not just looking to make a buck. So,
I mean, I was gonna say my take on the Indiana's landlord-friendly state doesn't mean we have the right to exploit tenants. It means no pay, no stay, which I personally agree with. And then two, most of the time it seems like tenants are paying utilities, so whatever. But you don't have to. As a landlord, you can choose to do whatever you want. So exercise, your vision for that property.
Yeah, we have found that it is actually more profitable to be relationally invested with the tenants and choose to work with them rather than file the paperwork and just, push paper and get them out. So if you have a tenant that can't pay, stepping towards them and saying, hey, we have a difficult situation here, and really setting that up as you sign the lease to start. Like, look, if you work with us and you have a difficult situation, we're going to sit down and figure it out together. Maybe that's getting you into a place you can't afford. Maybe that is figuring out a payment plan that's going to work better for you. Maybe that is working within our network and me calling Kenny and saying, hey, do you have anything that might fit this tenant? But we're going to find a way. And you know what? At the end of the day, if I need to give you your full deposit back plus $500 to enable you to be able to move within a certain timeline and get into a place that you can afford, we are all going to win way beyond filing the paper and going to an eviction court. Everybody actually does lose in that, whether we realize it or not.
Josh Matthews just joined our team, moved here from Brooklyn, and it was really interesting talking to him. He exclusively did leasing there, but he kind of shared, we met coffee for last week, and he was just saying like the culture shock of moving here with like the fast pace of New York to like the slow like Midwestern pace was a shock, but also like the transactional nature of real estate in New York versus here. I do think we have a bad rep generally in the industry for like being transactional, and specifically within landlord-tenant relationships. But I do think there's a good culture and core within Center Township and probably within this room of those who do that. We could all have room for improvement, but responsibly and fairly as we can.
Yeah, I mean, Mark Nottingham said at our summit, he's the co-owner of App Properties. He said, the reason we're investing is because if all the ethical investors dropped out, who'd be left? The unethical investors who would profit off it. So, it's an important role. We have time for one more question.
You guys, since I've gotten into real estate, it just seems like you never sell. Like why sell anything? So, have any of you guys on the board or in the discussion sold any properties other than a flip in the last 12 months?
Yes.
Why did you sell it?
It's a really good question. So I look at the properties where what the rent is at and growing at is being outpaced by the appreciation of the property. So if I've got a property right now, it is probably worth about $280. It's renting out at about $1,800. It's right about at that threshold where I'm going, you know what? Inside of another 12 to 14 months, that's going to be in the low 300s. I'm going to put the rent's only going to grow another maybe a couple $100, and I need to go ahead and get that on the market, take the win in the appreciation, 1031 exchange that into another asset that's going to be able to bump along.
How long have you held that one?
So far, I've had that about 9 months. I think the win, like the way to win on those, is look for the stuff, and there's a whole, but you got to be just ahead of the money that's coming in reaction. Like if you're an out-of-state investor, you're at a huge disadvantage.
Exactly. And I talked to a lot of out-of-state investors.
Yep.
Met them online, done some property management for them, and I see them struggle. There's one that just texted me earlier today, asking me for a quote to do a clean out, and I'm at a meeting, I'm not here. I'm like,
Yep.
I don't know how people do out-of-state investing personally.
I mean, you can do it and you can win, but if you're on the ground, the advantage of staying one block ahead, one street ahead, is absolutely tremendous.
Yeah, I don't know how people can do it, honestly.
It's
From a beginner standpoint, which
yeah,
I still feel that I am, but.
tremendous risk for sure.
So it's just the ratio, you're saying that once the value is so high, the rents are not keeping up?
Yeah, because you look at that and you're like, I can move this into another asset
Yeah.
that's going to be in line, right? And I'm looking at rents to keep up, and that I probably clip out 10 properties a year that are falling in that range.
Is that because you're following the 1% rule, sort of?
No, you know what, guys, I'm probably the only person in here who has never listened to a Bigger Pockets podcast. Like, I'm sure it's great stuff. I just started doing this before they got on board, and no, I'm looking for the appreciation play, and then I'm just watching and looking at what makes sense.
Cash flow is just your lunch.
Yeah.
That's how I see it too. Our properties, our single families, they're only cash flowing like $200 a month.
Yep.
But
And that's good.
bought some in 2018. Yeah, he told me it's great.
It is.
I
Yeah.
see people online and they're like, yeah, I'm cash flowing $500 a month. I'm like, where? Like,
Yeah.
you're not finding $500 a month cash flow right now.
Mhm.
23.
No.
I'm not anyways.
No. Maybe in Terre Haute.
So I've personally not sold. I am kind of crossing personally this threshold with my portfolio where I'm starting to identify similar stuff of like low-hanging fruit, where it's like, you know, one's an Airbnb, one's a multi, and I'm looking at kind of the equity, I think the way I guess I'm looking at it is like, if I can take this that's performing okay, and I can go from 1 door to 4 doors with that cash, I'm going to do that every single day, even if year 1 I'm cash flowing, you know, a couple $100, because I'm looking at year 5, year 7, year 10.
Awesome. I think that does it. Really appreciate you guys. I think all this was awesome information.
It's fun.
I will kind of recap who each of them are, just so if you're wondering what they do. Kenny's with Live Indy Property Management. You run the show there, basically. Mark Buckingham, you're with Full Circle, kind of development, investing. Anything else you want to mention there? Okay. Joel, you're a realtor. You're basically like me. We both realtors and invest. And then Rex, anything you want to say about?
I've been trying to tell people what I do for years. I collate papers, run coffee, and I get to do fun stuff. This is just a blast. It's great to be here with you guys. I'm so thankful you guys came out. This is fun.
Thanks for coming.
Yeah.
Yeah, awesome. Well, thank you guys.
Thank you.